With all this investment going into the Australian Taxation Office, they are conducting more and more audits, especially in the building trade, with the implementation of the Taxable Annual Payment Summary Report, which means that all businesses in the construction industry, if you're a contractor, whether you're a company or a sole trader, an ABN, the business that you've worked for will actually send a summary of all the income that they've paid you to the ATO. So in the past, your tradie would give you there, I've earned 55 grand throughout the year, Jeremy. Now we've actually got a contractor summary report to contrast how much money that they've earned. Now, on very rare occasions have I seen, some people in the open world have different amounts to what's been reported on the ATO, right? So this is how sophisticated it's getting. It's getting extended to other industries as well. The ATO will want to know what all businesses, what all sole traders are earning, because they fear that that is the risk, where the risk is. So very important, make sure that you are keeping those records. ATO are chasing people quite heavily. People, what have they picked up in audits for the past? The main things: overclaiming on tax deductions, overclaiming on private expenses, mobile phone records. They really do want to make sure that you are claiming an accurate percentage of your mobile phone. It's very easy to say I use my phone 60% of the time, but are you using your phone 60% of the time? So very important, you are keeping a diary. If you're travelling for work, you keep a travel diary. If you travel with your car, keep a logbook of your kilometres or a logbook of the overall kilometres you've done with inside a 13-week period. So they are really, really cramping down on the type of deductions that we're claiming. With property investors, they've taken away the travel costs for investment properties. They are looking heavily into sundry expenses, whether people are paying for that seminar and 5 people are going, but they're claiming all the ticket in their name. They are really clamping down. So us as taxpayers, as a self-assessed system, we're responsible and accountable for what we show. And it's ATO, unfortunately, run under a different jurisdiction. You're guilty until proven innocent. They send you out a bill, $2,000. You have to prove to them within 28 days that you're innocent. And if you don't get back to them within 28 days, the next letter comes. We're taking this to a debt collector. And if you don't pay, they are garnishing your account. And they have changed the rules of garnishee. Before you had to have about 30,000 plus over 12 months. Now it's $5,000 or more within 3 months.
They're not all bad people. There are good people and there are bad people as well, right? And all of those comments are right. And I went through, I suppose, being in the profession for about 21 years, is that I ran through a number of different audits. And what I found from my experience, Jeremy, is that whenever there is a review from ATO, ATO always gives you an opportunity saying that you self-disclose in your own review if you found something wrong. And what I've found is that many of our clients' case, I can give an example a few years ago, that one of my clients, we don't do their bookkeeping, we do their year-end set of accounts and the tax return. It's a big builder client and being audited. And the client came in saying that, guys, we got audited, we've got everything that we need to substantiate and so forth, can you manage it? And I said, well, we don't do the internal record keeping, so if I need to manage it, I need to do an internal audit. So I went back to ATO and I said, guys, I'm chartered accountant, I'm doing an internal audit. If you allow us, if you've given us a little bit of time, I might just need a bit more extra time so I can do that internal review by myself and then come back to you. And I found that very, very sort of welcoming from ATO's point of view. Yep, go ahead, do all of those. I've done that. And some of the things which I found were exciting. They were very, very different, right? The ABN doesn't make sense. It doesn't match, right? You've got the invoices from a whole lot of different suppliers, but the chronological order is exactly the same. And some of the things, right? So it was not the best. So what we did is that we went through, we identified all of those. We actually fixed the problem. We fixed the problem as much as we could. There was some super issue as well, so we fixed all of those. We sat down with the ATO. In day one, we submitted everything, saying, guys, there are a few things went wrong. That sort of went wrong. Our client has gone back and fixed all of those. And more importantly is that our client has taken system and the procedure so it doesn't happen ever again. And what we found that it was good. And ATO was very, very, very understandable. So my sort of professional, my personal view, professional view is that ATO is not there to get you, right? ATO is not there to get anyone else, right? ATO just says very simple thing, guys, you guys do the right thing. and we'll do the right thing as part of the community as such. So one concept, I suppose, is the reasonable man test. And I use that example quite a bit, that when we claim a deduction, yes, we got to follow through the rule and the court of law as such, but does it make logical sense in terms of deduction? Yeah.
And that's important, guys. And I'm sure you've heard, for any business owners out there, one-touch payroll's coming out very soon. It's implemented by the ATO. Virtually, when you pay an employee, it's going to automatically pay the super, it's going to automatically pay the PAYG. And again, it's just measures the ATO are bringing in to assist business owners and not to leave their employees stranded. So there's lots of different things happening in that world at the moment. But my advice is, Manzoorul's advice would be the same, is be fair. Be fair. The tax system, yes, we do sometimes get a bit of refund back on the deductions that we claim, but it's on the money that we've spent. We can't make up numbers out of thin air. They don't exist. That's not the way the tax system works. And that's what all this money is going in to implement, is to stop people doing that. So I suppose they're the big ones. And then benchmarking, Manzoorul touched upon it, how it works. Essentially, they've got a whole lot of data from all the tax returns that are lodged around Australia, and they are contrasting you against other people inside the same industry. So if you look too much, you're the tall poppy, they will ask a question, and it's up to you guys to answer it. So very important, you are speaking, you are understanding what type of deductions that you can claim, but also, are they reasonable?
So I suppose, Jeremy, if I may ask the question, that from the ATO, sort of the audit and the risk side of it, so we're all property investors, most of us, all of us, right? So from the investment property side of it, what would be some of the sort of the fundamental things which has got a higher level of risk in ATO's mind? When we look through that Excel, which, say, Scott has done with the income and the expense side of it.
So the ATO are looking at a number of different things. So buyer's agency fees, training, seminars, education. They are looking at those particular deductions. Is the training entirely for the property investment journey? So for instance, if you're doing a real estate agent course, does that really relate back to your property investment, properties or journey that you're going through? So a lot of different things that they are looking at. Repairs and maintenance, they are scrutinising quite heavily on the repairs and maintenance for the property, whether it's replacement, being depreciation, or whether it is a genuine repair, like I fixed a panel on the fence, or I replaced all the colorbond fence. So these are the things that they are trying to look at, they are picking up, and these are the things that we pick up as an accountant to make sure what's depreciable and what's not. And interest as well. Yeah. If you top up your loan, I've seen it in the past, cheeky, they've extracted a little bit of investment, a bit of equity from their investment property, and they went and bought a beautiful Mercedes-Benz. Beautiful.
What was the purpose of the car?
And they tried to claim it as a tax deduction, but you can't. So again, the purpose of the loan determines whether it's deductible or not. So we've got to make sure when we're doing our loans, extracting equity with our brokers, that we are really identifying what the purpose of that loan is for. Okay, we can't buy, unfortunately, I'd love to buy Mercedes-Benz, claim it as an interest against the property, but we just can't. It's not deductible debt.
And I suppose the other thing which I sort of say, I agree with all of those, is that whether the property was available for rent. And that's very important, particularly when someone buys it for the first time, and whether you, let's say that you bought this property for $330,000 in Brisbane and it's a fantastic buy, it's an absolute shibaku that you need to spend $30,000 in terms of the renovation side of it. It took you 3 months. And the question that comes in is that within that period of time, whether the property was available for rent. You may have done repairs at that stage, but is it really a repair? It becomes your initial improvement. It becomes capital. And a portion of that time also becomes capital as well. So all of those things. So what we do, Jeremy and I, quite a bit within ourselves, is that we always cross-check with the last year. Right? We always cross-check with the last year, and that's a good your own a check. So we look through simple thing on the interest as an example. Let's just say that a Mount Druitt property receiving about $400 rent, so it's at 20,000 as being the rental income. We've got bits and pieces of expense, and let's just say that it was purchased a number of years ago for 200 grand. We've got the details. Let's just say loan was about 200 grand. So interest is about 4.5. So it's about 9 grand is the interest, right? So we've been claiming about 9 grand. It's interest only every year. Give or take, increases a bit, lowers a bit. So when we do this year's tax return, all of a sudden when we see the interest has gone from 9 grand to say 13 grand, the natural question that we ask is that why has the interest increased, right? Because the interest rate really hasn't increased that much. and you seem to be with the same bank, and then all of a sudden you've got about 40-50% additional increase of your interest. So you may have taken that loan. Now, you may have done that loan because you've sort of taken that bit of funding, let's say for argument's sake, to build a granny flat at the back of it on that property. Then that's fine. We can claim that on that property as well as the granny flat. But it comes back to the purpose.